Hello. This is the third video on agriculture finance and insurance. In this video, we are going to cover the classification of credit. In previous video, we have covered the agriculture finance meaning, definition, nature, scope, and also credit definition and requisite of good credit system. In this video, we are going to cover the classification of credit. Myself, Professor Vaishali Bharat Bholap. See, this is the classification of credit. Credit is classified based on purpose, time, security, liquidity, activity, approach and contact. One by one we are going to see the classification with the suitable example. First we are going to see the classification based on time. Okay, or sorry, classification based on purpose. The classification of credit based on purpose is production loan, investment loan, consumption loan and marketing loan. First of all, production loan. Production loan is the credit given to the farmers for crop production, okay, and are intended to increase the production of crop. This loan is also known as crop loan, or we can say the seasonal agriculture operation loan or short term loan, okay. These loans are repayable within a period ranging from 6 to 18 months in lump sum, that is production loan. Second classification based on purpose is investment loan. These loans are given for the purchase of equipments, the productivity of which is distributed over more than 1 year. The loans given for tractor, pump set, electric motor, tube are the example of investment loan. Then first of all we are going to see the marketing loan, then consumption loan. Marketing loan, these loans are meant to help the farmers in overcoming the distress sale and to market the produce in a better way. Regulated markets and commercial bank based on the warehouse receipt are lending in the form of marketing loan by advancing 75%. Listen carefully, 75% of the value of the produce. These loans help the farmers to clear off their debt and dispose the produce at remunerative prices. Okay, that is the main purpose of marketing loan. Then consumption loan. Consumption loan is any loan advance for some purpose other than production. Is broadly we call it as a consumption loan. These loans seems to be unproductive but indirectly assist in more productive use of crop loan. That is without diverting them to other purpose. Okay. Consumption loans are not very widely advanced and restricted to the area which are hit by natural calamities. Consumption loans are extended based on group guaranteed basis with maximum of 3 members. And this loan is to be repaid within 5 crop season or 2.5 years, whichever is less. The branch manager is vested with the discretionary power of sanctioning these loans up to rupees 5,000 in each individual case, and the rate of interest is around 11% for consumption loan. Okay, this is the classification based on purpose: production loan, investment loan, consumption loan and marketing loan. Now classification based on time. Okay, classification based on time. Credit is classified as a short term, medium term and long term. Short term loan. Short term loans are loans to be paid within a period of 6 to 18 months. All crop loans are said to be a short term loans, but the length of repayment period vary according to the duration of crop. Okay, the farmers require this type of credit to meet the expenses of ongoing agricultural operations on the farm, like sowing, fertilizer application, plant protection measures, payment of wages to casual laborers. Okay, for that purpose he wants the loan. The borrower is supposed to repay the loan from the sale proceed of the crop raise. Okay, that is short term loan. Period for short term loan is 6 to 18 months. Second type of loan is medium term loan. Medium term loan is, here the repayment period vary from 18 months to 5 years. Medium term loans are required by the farmers for bringing out some improvement on his farm by way of purchasing implements, electric motors, milch animal, sheep, goat. Okay. The relatively longer period of repayment of this loan is due to their partial liquidating nature. Short term loan is self liquidating loan. Medium term loan is partially liquidating in nature. Then long-term loan. Long-term loan, these loans fall due for repayment over a longer period of time, ranging from 5 years to more than 20 years or even more. These loans together with medium-term loans are called as investment loan or term loan. Medium-term loan and long-term loan combinedly we call it as an investment loan or term loan. These loans are meant for permanent improvement in like leveling, reclamation of land, construction of farm building, purchase of tractor, raising of orchards. For that purpose, long-term loan is preferred. Since this activity requires large capital, a longer period is required to repay this loan due to their non-liquidating nature. Okay. Short-term loan is self-liquidating loan, medium-term loan is partially liquidating loan, and long-term is non-liquidating in nature. This is the classification based on time. Now we are going to see the classification based on security. Okay. The loan transactions between lender and borrower are governed by a confidence, and this assumption is confined to private lending to some extent, but the institutional financial agencies do have their own procedure formalities on credit transactions. Therefore, it is essential to classify the loan under this category into two subcategories, that is secure and unsecure loan. Okay. Secure loan. The loan advance against some security by the borrower are termed as secure loan. Okay. Various forms of secure loans are personal security, collateral security, chattel security, mortgage and hypothecation. This is the classification for secure loan. Personal security. Under this loan, borrower himself stand as a guarantor. Loan is advanced on the farmer's promissory note. Third party guarantee may or may not be insisted upon. Based on the understanding between the lender and borrower, this loan is issued. Okay, this is the personal security loan. Now, collateral loan. Here the property is pledged to secure a loan. The movable property, which property? That is movable properties of individuals like LIC bond, fixed deposit bond, warehouse receipt, machinery, livestock are offered as a security in collateral loan, collateral security loan. Then chattel loan. This credit is obtained from pawnbrokers by pledging movable properties such as jewelry, utensil made of various metals or prestigious metals. Okay, that is called as chattel loan or chattel security loan. Then mortgage. Mortgage. As against the collateral security, immovable properties are presented for security purpose. For example, land, farm building. Here the person who is creating the charge of mortgage is called as mortgagor or borrower, and the person in whose favor it is created is known as mortgagee or banker. Mortgage are of two types. Mortgage are of two types, that is simple mortgage and equitable mortgage. Here simple mortgage, when the mortgage property is inherent property of borrower, then simple mortgage is good. Here farmer borrower has to register his property in the name of banking institutions as a security for the loan he obtained. The registration charges are to be borne by the borrower. That we call it as a simple mortgage. Then equitable mortgage, when the mortgage property is self-acquired property of the borrower, then equitable mortgage is applicable. In this, no such registration is required as in simple mortgage because the ownership rights are clearly specified in the title deeds in the name of farmer borrower. That is equitable mortgage. Then hypothecation. Okay. Here borrower has ownership right on his movable and the banker has legal rights to make a possession of property to sell on default or right to sue the owners to bring the property to sell and for realization of amount due. That is hypothecation. The person who creates the charge of hypothecation is hypothecator, that is borrower, and the person in whom favor it is created is known as hypothecatee or bank, and the property which is denoted as hypothecated property. Okay, this happen in case of tractor loan, machinery loan. Under such loan, the borrower will not have any right to sell the equipment until the loan is clear off. The borrower is allowed to use the purchased machinery or equipment, so it is so as to enable him to pay the loan installment regularly. Physical possession of the equipment is with the borrower. Okay. Again here hypothecation loan is classified into two parts, that is key loan and open loan. Key loan is the agriculture produce of the farmer's borrower will be kept under the control of lending institutions and the loan is advanced to the farmers. This helps the farmers from not restoring to distress sales. Okay. Then open loan. Open loans, only the physical possession of the purchased machinery rest with the borrower, but the legal ownership remains with the lending institutions till the loan is repaid. That is open loans. Now unsecured loan. Unsecured loan, just based on the confidence between the borrower and lender, the loan transactions takes place. No security is kept against the loan amount. That loan we call it as a unsecured loan. Now classification based on liquidity. Self-liquidating and partially liquidating. Self-liquidating, they generate income immediately and are to be paid within 1 year or after the completion of one crop season. For example, crop loan. Partially liquidating loan, they will take some time to generate income and can be repaid in 2 to 5 years or more based on the economic activity for which the loan was taken. For example, dairy loan, tractor loan, orchard loan. Okay, because in case of dairy loan, income is not generated immediately after the purchase of cattle or dairy animals. That's why it is called as partially liquidating loan. Then classification based on activity. Classification based on activity, that is based on the business activity, like dairy loan, poultry loan, tractor loan, land development loan. Specific activity is mentioned in the activity loan. Okay. Then classification based on approach. Okay. Here individual approach, area based approach and DIR. Okay, differential interest rate approach. Individual approach. Loan advance to individuals for different purposes will fall under individual approach loan. Area based approach. Loans given to the persons falling under given area for specified purpose will categorize as the area based approach. For example, drought prone area program loan. That is the example of area based approach loan. Then DIR means differential interest rate approach. Under this approach, loan will be given to the weaker section at 4% interest rate per annum. That is DIR. Last classification is a contact. Okay, direct loan and indirect loan. Direct loan, again Direct loans extend to the farmers directly are called as direct loan. For example, crop loan. Indirect loan given to the agro-based firm. For example, fertilizer, pesticides, insecticides which are indirectly beneficial to the farmers are called as indirect loan. This is all about the classification of credit. In next video, we are going to cover the credit analysis. Okay, that is 3 R's, 5 C's and 7 P's of credit. Thank you.